Stocks I'm buying January 2023. Today I'm going to go through all the stocks that I've been buying recently, going towards January, so get yourself comfy. It's going to be a long one. Let's do this. And then as always, if you want to know what I'm buying and selling in real time, the place to be is on the Patreon, as well as that you get 2 exclusive videos every week on there. So if you do want to join, link is in the description. But let's get started on this list. It is a bit of a long one today. So I've positioned this so I've got all the big tech, all my big market cap stocks at the start of the video, and we get to some of the smaller market cap stocks by the end of the video. Depends what stocks you like, I guess. So first of all, Google. There's no surprise here. I've been on the record quite a few times recently saying Google is my number one stock I want to be buying. I want Google to be my largest position, but the only way I'm going to get Google to my largest position is by this share price keep going down or stays down here for at least another 12 months. If it does that, I might be able to do it. So we'll see what happens. But Google is the stock that I have identified as the one stock that I really want to be buying the most. So when you look at Google's recent earnings, you can see here, they were okay. They're okay. We know Google is going through some pain at the moment, and that is probably why we're seeing the share price declining so much. This is probably why we're seeing Google now trade at 17 times earnings. There's a bit of pain going on in Google's numbers. You'll see here that revenue here did move it up in the right direction, but it is going through these tough comps. So Google historically grows around that 10 to 20% rate on revenue, and you can see here in 2021 there was a massive boom in the revenue, and that ended up with them shooting up 41%, and there was a lot of demand pulled forward. You top that off with the current recession fears, the environment that we're going in, marketing spend being pulled back, and Google is having a slower year down at 6%. And you also factor in the strong US dollar at the moment, which means that they're actually having a bit of an impact on that front as well. So 6% year over year is obviously below what we want for Google. We want to see this in a double digit, and I think that will come back. But also, if it wasn't for the strong dollar at the moment, we would actually see Google grow at 11%, which I think is not too bad considering the environment that we're in and the amount of companies that are currently pulling back marketing spend. So I think that is actually quite a bit of a positive. The only other negative is we're seeing the operating margin decline. You can see here Google went from a 32% operating margin down to a 25% operating margin, and that also meant the operating income did decline a little bit here. But like I said, I think that this will sort itself out in the longer term. It is making a few investments at the moment, and I think this will move back into a positive direction in 2023. And it's also worth noting, as you can see here, other income did have a $3 billion impact of that profit drop. So you can see here, if it wasn't for that there, we would actually see it not down that much considering the investments that they have made recently. Now we dig into the actual company. Obviously we've got Google Search. Google Search is probably going to be, I think, one of the strongest moats out there. I can't see any competition really coming to affect it. I mean, do you remember the days when it used to be, is it Google, is it Ask Jeeves, which one do you use? I think there was even Yahoo Search at one point, and now Google has just, if you're looking for something, what do you do? Oh yeah, I'm going to Google it. And obviously, the Google Search platform is untouchable, and obviously these paid ads here. So if I'm looking for a new kitchen, which I'm generally not after that expensive Christmas that we've just been through here. Jeez, I'm definitely saving some money up after Christmas. But, if I was looking for a new kitchen, you can see here that people pay to get higher up on the search engine. You've got Wix trying to get up here at the top. This is obviously another good income that Google do make, and it's probably an untouchable area, and they'll probably just keep slowly increasing the adverts cost to go up on here. You've got YouTube ads, which obviously YouTube is a fantastic platform compared to like a Disney or a Disney Plus or a Netflix. It's content that's provided by them for the creators like me who just upload it. YouTube don't have to pay crazy money to have the content on there, and obviously they just stick the adverts on there. They make a cut of the adverts, they pay it out to the creators. I think YouTube is only going to carry on growing and growing. More people like using YouTube. Google Network, obviously Google Advertising, Google Other, and obviously Google Cloud. Now this is really interesting because Google Cloud, if you look here, amazing growth. This is actually stronger than the likes of Amazon and Microsoft. So Google Cloud is actually really performing really well. Now obviously the only little downside to Google Cloud is that it's currently still loss making, but if you look at the likes of Amazon and the amount that Amazon Web Services does pull in for profitability, you are kind of thinking, well, if Google can get to the lines of what Amazon does on profitability side of it, and it's growing at these sort of rates, that's something quite interesting. And obviously you've got the other bets, and there's a million things that do come under there. So yeah, you've got a very good moat here that I think is very untouchable with the YouTube search side of it. And also it's really interesting to see what the cloud does further down the line. So it looks pretty good from that point of view. So when you look at Google, you're getting growth drivers that I think will continue with the search, the YouTube and cloud. And then you top up the valuation metrics you're staring at for Google right now. Total enterprise value to revenues, it's a 3.5. It's not been them sort of levels in the last 4 years. Same on the price to sales point of view. On a total enterprise value to EBITDA, it's a 9. Same again, the highest it's been is around about a 12. You look at the normalized P earnings, it's down in the teen range, which is obviously really good. You look at the free cash flow, it's a 15. Obviously, it used to trade in the high kind of 20 range. So on a metric point of view here, it's standing out at a very low compared to what it's historically been at the moment. And I think the revenue will return once they get these hard comps out of the way, like we saw earlier. You know, moving that from that 40% revenue growth range, it's always going to be hard to move on there from when you normally have a 10-20% growth rate. You can actually see here the boom that it had up on the revenue, you know, naturally uptrend, and then boom, it shot up because of that big massive increase of revenue. And on a profit point of view, same again, it had a big crazy boom in profitability, not sustainable. That's going to just calm down a little bit now, but then in the future we should see profitability come back, and I think we'll have a company here that does grow at least double figures, and you're getting a pretty good valuation for it. And not to mention, you are probably picking up the strongest balance sheet on the stock market at the moment. 5% debt to equity. You look at the cash pile, 116 billion in cash. Yeah, that's correct. 116 billion in cash. A 1.1 trillion company with a 116 billion cash pile. Wow. So yeah, I think this is a absolutely gem of a stock to be buying in this crash. The next one is PayPal. So PayPal is currently $71. I actually am really surprised that PayPal isn't getting as much attention as what I think it should do. I think PayPal at the moment is a very interesting stock, and I don't see many people talking about it on the lines of like a Google, for example, at the moment. I think PayPal is definitely an attractive investment right now. Obviously a great brand. Obviously people are using PayPal just because of, you know, sending money to friends, also paying for things online. Obviously there's that concern about using your, you know, debit cards, credit cards online, but using PayPal is seen to be a safer option to kind of check out with. And the actual PayPal platform, I think, will still do very well going forward. You factor in other parts of the business, you got Zettle. I've got to say, I went to that many Christmas markets in December, and the amount of times I was actually paying on these Zettle payments was unbelievable. I was like, wow, a lot of people are starting to use them now. So obviously this is a area that could be quite interesting going forward. Obviously, probably one of the more interesting parts as well is obviously Venmo. You know, the kind of competition to Cash App to send money to your friends. Obviously another fast growing area here. And when you actually look at the last third quarter earnings, they were okay. You know, PayPal at the moment is going through a few issues like Google, where it had such a massive boom in 2021 and now it's having a bit of a consolidation phase. But you look at the, you know, what it was in this period of time when it's had these hard comps, and you actually look at these numbers going, they're actually pretty good numbers though. You look at net revenue, it was growing 11% and 12% on an FX neutral basis. If you exclude revenue from eBay, because obviously PayPal recently moved away from income from eBay, it actually grew 13%, and on a spot basis, 14%. Operating cash flow as well, growing 29%. Now the profit has decreased slightly on this stock at the moment, but actually when you look at the free cash flow of the business, it's actually throwing off a lot of free cash flow at a really low valuation. I'll point that out to you in a few minutes time. And it's also working with Apple to enhance its offerings, and PayPal and Venmo will be able to be used on Apple on the iPhones, you know, the tap and pay. It's actually quite funny this. I don't know if you actually saw the story on this, but basically Apple obviously were on iPhones were just saying, oh, use Apple Pay, and then they got into a bit of trouble. There was a lawsuit against them saying, no, you can't just use your own products. That's something, you know, you're not allowed to do from a regulatory point of view. So obviously before the lawsuit actually was decided, Apple suddenly went, oh, you know what, let's go get a partnership with PayPal then. And so they got a partnership with PayPal, so you'll actually be able to use Apple Pay now. You'll be able to use like Venmo, you'll be able to use PayPal, which is obviously really good. That was probably one of the concerns, is that people are just going to keep using, you know, Apple Pay more and more because it's easier. You also see here that Venmo was now a payment option on Amazon, so that's quite interesting to see if that keeps ramping up. Obviously we have no numbers yet because it was just launched in time for Christmas, something that I'll be checking out in the latest conference call. And you can see here that Zettel was expanded to the US as well. So we'll see if that really takes off over there. Now, digging into PayPal, you'll be able to see here, once again, a bit like Google, they had a bit of an explosion out the CV situation with revenue jumping up a really big amount. They had profit jump out a big amount, and it's just been kind of reinvesting back into the business. Revenue has slowed down a little bit, off these tough hard comps. But going forward, same again, we should expect double-digit revenue growth from this business, and same again, we should see the profit start coming back a little bit after the dive down here. But actually, when you look at free cash flow point of view, the free cash flow is still chucking off 5.6 billion, and at an 81 billion market cap company, I think that's pretty attractive, and that should carry on increasing as well. And that's also when you get into the metrics point of view. You'll be able to see here that it trades at a 3 times enterprise value to revenues. You can see here the lowest it really was around about a 5 in 2018. Total enterprise value to EBITDA, it's currently a 14. Same again, if we go back to 2018, it was a 21. Normalized earnings, obviously 19 compared to 33. And what we just speak about free cash flow, you're picking up 15 times free cash flow. Previously, it's been 20s, 30s, even obviously when we went to a bit of a crazy valuations and stock prices in 2020, 2021, 46.50, obviously, the stock did get a little bit overvalued there. But I think, picking up a stock like this at 15 times free cash flow, I don't mind that opportunity at all. So the next big tech or big stock that I'm picking up is Walt Disney. Walt Disney at $86 for me. I'm a really big fan of this one. It's the same sort of levels that it was in the CV times. It was the same sort of levels it was before I even had the Disney Plus launch. And the Disney Plus launch has been so successful in the last 3 years. We've seen the adaptation to the amount of subscribers really catch up to Netflix faster than what we thought it would. While Netflix has had subscriber issues and subscriber growth issues, Disney Plus has still done very well, and there's some exciting programs coming this year. Personally for me, I'm looking forward to The Mandalorian when it comes out. And where Disney has been this kind of classic parks and the resort you go to and the Disneyland locations, this is the new growth driver for Disney, this streaming platform. And when you've got the content that Disney has and the content that they can throw off and the characters they have, obviously that's something amazing. So I'm really looking forward to what Disney can do with this Disney Plus platform going forward, and it should offer them more growth than they've ever had before. Now, the worry around Disney is the cost of the streaming platform. You can see here free cash flow took a dive in the last quarter, and even though the parks came back really strong in the last earnings report, you can see here the big massive boom up, and that really did help the revenue. And also the actual Disney Plus platform was still growing at 19%, which is really good growth. The problem is if you look at the losses that Disney Plus is creating at the moment, that was a massive spend. So even though the growth is looking very attractive on Disney, the problem is that the costs that it's coming at for this Disney Plus platform. Now, Disney have said this is kind of the peak stage now. We're going to move into a positive direction, and I do believe them. And one thing that will be very noticeable in the next earnings report is Disney Plus will be doing their price increase. So obviously the prices have gone up. They went from $7.99 a month to $10.99 a month. I believe, it was on December the 8th that this happened. So very quickly, maybe not in Q4 actually, but particularly in like Q1. Obviously, one thing you're going to be noticing is that Disney Plus is going to have a massive boom because of the price increases, and that's obviously straight away you're going to sort these losses out. You look at $7.99 a month, we know that wasn't going to happen forever, and obviously now that's going to help the finance point of it. And obviously, the big thing is when you do look at the losses of Disney Plus, you look at someone like a Netflix. Obviously, Netflix has now got to a more mature point than Disney Plus, but Netflix is now starting to, focus on profitability. And you look at the profitability of Netflix in the last kind of 5 years, and you'll see here the profit margin going from 4%, 5%, 7%, 10%, all the way up to 16%. So you can see here, like Netflix, for example, their profit margin has massively increased, and you think, well, if Disney Plus gets them sort of profit margins, that's actually going to be pretty good amounts of profit it's going to add on. And obviously it's still growing at very good rates. So that's what the target really is for Disney Plus to get to in the next kind of few years. And that's what we want to see really Disney start to, ramp up. We know the revenue is now starting to get to a point where it's above the CV times in 2019. So that's a really good thing. Obviously, we've still got a lot of parks still to do, a full year operation. Obviously, some of the Shanghai park location is still facing lockdowns at the moment, or has been throughout the year. So there's still a bit of revenue still to come from that part of the platform. So we should see revenue still do very well. We still want to see the profitability come back on that part of the platform. And then obviously if Disney Plus doesn't start, stops losing as much money as what it is, and these price hikes come in, as well as a few other things, we start seeing Disney start pushing back up to let's say a 10% profit margin, 15% profit margin. Very quickly you start running the revenue, and let's say they're able to get to a 10% profit margin, and we start building up from there a little bit. You can see very quickly that you start looking at Disney and going, okay, if you start valuing off what it is right now, obviously it's a little high at the moment because of the factors that we just mentioned, but you start thinking, okay, if they can get back to the old levels of profitability they had, you can see here, unless they're actually forecasting that to start happen in the next few years, you start forecasting the profit, can they get to some, close to the previous levels that they used to have before? And then you start saying, well, you look at the past levels of Disney, Disney was a stock that basically stayed flat. Because it just had the parks, there was basically no growth. And then you start thinking about the growth that they could potentially have from Disney Plus. It becomes quite exciting what they could do in the next few years. So yeah, I think Disney's a very good stock at the moment to be looking at. Now the next one is Tesla. And look at this, I prepped this video, and you've just actually seen it change there. I prepped this yesterday, and you can see here, it was before the market opened up, and they just see the drop off there. Was it $124? And then it just went bang, $108. And yeah, the free fall continues on Tesla. I mean, I was like, oh, is it gonna get to $100? It's getting there. We potentially could be seeing Tesla come in at single digits, which is just double digits, sorry, not single digits. Well, you never know, it might go single digits, but we might see it come double digits. 33 times earnings. Now, because I did the research all for this video yesterday, I haven't got the reason why it's dropped 10% today, which is obviously to do with the deliveries. Deliveries came, I think, 3% below estimates, which was obviously not great, but it wasn't worrying. But I mean, whew, you start thinking, okay, how much negativity is priced into that drop? And then the missed deliveries by 3%, you're like, okay, it wasn't great, but it wasn't terrible, especially when you consider the environment that you're in. And then the share price drops 12%, and you're like, whoa, like, didn't expect that. Well, you think there's some negative priced in, and then it drops 12%, you're like, okay, this stock is on free fall. This stock is dropping and dropping and dropping. And this is what I said a while ago. Like, I'm looking at Tesla, and I think that, they're going to be, they already are an EV giant, but they're going to be a bigger EV giant in the next few years. And I want to own, the number one EV player in this sort of space. But there's also the point of view to be cautious, because when your stock is doing that is one steep slope down there. No one knows where this is going to bottom out. There's the term of catching a knife. Don't catch a falling knife. This is it. This is a falling knife big time. So for me, I've just I'm very slowly buying into Tesla. I'm buying probably once a month into Tesla, and I think if I buy once a month in the next 12 months, I think I'll come out with, I want it to be about a mid-sized position, and I think I could potentially get around about a mid-sized position after about a year, potentially. We'll see what happens. But if I buy once a month across a year, it should be okay. And I should come out with a pretty good average. So I'm being really, really slow on this one. I am trying to build it across a 12-month period. So yeah, definitely not one to rush into. But at $108, I think it does start to get a little bit tempting. Obviously, the EV space is massive. It's going to grow at a CAGR, as you can see here in the UK, of 13%, which is a massive amount. You think about the infrastructure, we're still not even there. Tesla can build more of these supercharge stations, as you can see here. There's definitely a lot of room for a lot more, especially here up north. Obviously, we get things a bit last up here, but there's definitely room for more. The Powerwall, I mean, this doesn't get much attention. This is another income stream, basically, that they could go into. Obviously, the Cybertruck is coming, new category for Tesla to enter into. I think the sales will do very well on that. We get that at the back end of the year. Obviously, we've got the semi-truck coming out. Obviously, there's a few questions around the range at the moment. But obviously, what will Tesla do? They'll just keep increasing that technology, and you'll just see slowly the range on these trucks getting bigger and bigger. So obviously, that's another income stream that they're in right now. And obviously, the concern is the slowdown. Obviously, there's the concern that we are entering a slower time in the economy. what is the last thing you're going to do? You know, you're not going to go out and buy a car in a slowing down economy. If you're worried about your spend or the economy out there, you're probably not going to dump it all in a brand new car. So that's the worry down here, the slowdown that's going on. Obviously, we saw that with deliveries at the moment. And when you look at analysts, I think analysts are still, they're still offering at the moment 37% year over year growth, which actually when you look at the deliveries, I think the deliveries were like 40% year over year growth. So when you actually look at the deliveries, they're still achieving that at the moment, which is obviously, you know, fantastic in this sort of environment. But the concern is that it's going to get, you know, lower. And obviously, when I look at analyst expectations of 37% year over year growth, I don't think they'll do that. I expect Tesla to come somewhere in the 20 to 30% revenue growth. You probably saw it in my predictions video yesterday that's where I think they'll end up coming in. So I think that's why there's probably still a bit more pain. You know, I think people are adjusting to kind of this, you know, Elon Musk that said 50% revenue growth, and then analysts are now moving it down to 37%. And I think there'll be a bit more pain until they get to where I think they'll be, which is, you know, that 20 to 30% revenue growth. So, you know, it's one to definitely be careful of at the moment. But the company has done fantastic the last few years, and sometimes you do forget like how strong that balance sheet is now. It's in such a good place now because of the debt they're paying down and all the profit they're starting to make as well. Obviously, the negative side of it is, let's just go on ownership. Woo! There's a lot of Elon Musk sales going on there. Obviously, that's a little bit of thing that's, you know, weighing down on the company right now. He has reduced his stake quite a bit. He still owns quite a bit though. When you look at that 13% of the company, which is still a healthy chunk. Obviously, there's the Twitter situation that's going on. That's obviously causing a few pressures on the stock as well. So the sooner that he moves away from that is probably better as well. The media are loving that at the moment. But, you know, valuation point of view, it's getting to, you know, quite low levels. You know, 3 times enterprise value to revenue. On a enterprise value to EBITDA point of view, it's a 14. On a normalized P earnings, you know, it's down to a 4 on a 23. You know, free cash flow is down to 29. And you know, this isn't like a company that we're just talking about, for example, like PayPal and Google. You know, they're very more mature companies. These Tesla's still very much in its, you know, early growth stages, or maybe it's still, you know, maybe not early growth stages, but it's definitely still in its growth stage. And you got to remember, this year, you know, this company is projected to, you know, throw 37% revenue growth. Now, like I said, I don't think it'll do that. I still think it'll come in at like 20-30%. But 20-30% revenue growth, and then you start thinking that's in a very bad year. You know, the bad years aren't going to last forever, and you still got the whole EV boom to go going forward. It's not a bad valuation. Now, I think it can double from here, but like I said, it's a bit of a falling knife at the moment. Time to be patient. If it does go lower and lower, fair enough. But you know, I think in the next 5 years it'll double from here. But if it goes lower, you know, I'll look at picking some shares up. So yeah, I did nibble at some Tesla. The next one is Block, or better known as Square. Probably the worst name change of a company that we've ever seen on the public stock market, but hey. So Block, Square, I like this one massive. So obviously we've got a lot of incomes going on. So first of all, we've got the Cash App. Cash App, #1 payment platform in America, sending money to your peers if you want to buy Bitcoin, if you want to go buy stocks on it. Yeah, it's a very well used app. So that's you're buying the #1 finance app in the US to start with. Next thing is the Seller, which is the side that I'm actually really interested in, because the profit they're going to throw off in this is amazing. They offer a lot of different points, as you can see here: invoices, payroll. You can do virtual terminals, e-commerce, get access to capital. When you look at the recent financials, you'll be able to see this starting to happen here. So if I actually just scroll down here to the recent earnings, you'll be able to see that transaction-based revenue, obviously the Cash App, was growing okay. This is the big part that I'm interested in: subscription and services-based revenue. So this is recurring revenue that they get from a few of their services that we just looked at here. So some of these are subscription-based revenue that businesses will keep on using, and they keep adding more features in for businesses to use. Now, the great thing with this subscription revenue is it is the fastest growing part of the business. So you look from a year ago here, subscription and service-based revenue was a very small part of the business. And within a year, because it's growing so fast, it's catching to be the largest part of the business, which is fantastic. And the great thing about the subscription and service-based revenue is the gross margins on this is like 70-80%. So what you have here is you have this coming your biggest part of the business, and then it throws off a lot of profit, which is great. Hardware revenue, which is like the card machines that you pay on, so that's only a small part, not really interested in that one. Obviously Bitcoin revenue obviously went through a bit of a boom through 2020, 2021, so obviously that's having a bit of a cool down here, so that's basically flat, but they don't make much money off the Bitcoin revenue, so I'm not really bothered about that part of the platform. And you can see here, for example, the transaction-based revenue makes good amounts of profit. The look at this, right? Subscription and service-based revenue. The cost of revenue is 225 million, and you look here, and the revenue is 1.2 billion. Unbelievable gross margins they're throwing off on there. Hardware, yeah, same. I'm not really too bothered about that. Bitcoin, they basically do it for break even, which same again, I'm not too bothered about it. But the Cash App, as long as that keeps growing, and the subscription-based revenue, honestly, major profit drivers going forward, and that's why they do decent gross profit now. And if it wasn't for the big boom in product development, which a lot of that is to do with the acquisition of Afterpay, sales and marketing did go up a little bit. You can see general and admin did go up quite a bit. If it wasn't for these big expenses that were just increasing there, this company's throwing off really good amounts of profit as well, which is obviously fantastic. And for a company, once again, that we talk about that went through a boom, I mean, you talk about a company that went through a boom. So they went from 4 billion all the way up to 17 billion. So there's been a boom. So you can see here, they've had a massive explosion at the moment. So the revenue is going to be a little bit flatter, but we're going to see that growth come back with that Cash App and that subscription base in 2023, and it'll go back to doing really good amounts of growth as well. So yeah, I think that that's going to be interesting this year. And then when you look at the valuation point of view, total enterprise value to revenues, it's a 1 compared to like 14, which is crazy. You look at enterprise value to EBITDA, it's currently 32, and it's normally being around 70, 80. Free cash flows down at 37. Same again, it's normally towards the 90, 100 range, obviously. So without doubt, Square is a bit of a premium company, but I really do like what they're doing at the moment. So I did pick some Square shares up. Next one is Shopify, very similar to kind of a Square. Shopify is the go-to site if you want to create an e-commerce site, and obviously once again these guys had a major boom in the last few years. Basically they do a couple of things. So there's the subscription solution, so basically you subscribe to one of the plans and you have your website. The other part of the platform they have is the merchant solutions. So this is the area that's really growing, because after you get your site, for example, you go buy some more features for your site. So for example, you manage Shopify payments, they manage your payments for you, you do advertising through them, you want to get capital from Shopify. The new part, the shipping, so they ship the products out for you. Shopify's point of sale, and Shopify email and marketing tool. So these are big features that they keep adding in more and more, and you can see the growth here actually of the chart here, really good chart that shows the merchant solution growth that's going on. So you get sucked into the platform and use that platform, and then you buy more and more features from Shopify that they keep adding as well. And once you're stuck in that kind of Shopify cycle, it's very hard to get out of, because why would you move? You set it all up, they're doing everything for you, and it's quite a sticky platform. And when you look at the recent financials, you'll be able to see that I can't actually go on it because oh no, here we go, it worked. You can go on solutions, you can see here that it's been a bit flat, but you see the merchant the subscription solution has been a bit flat, but you can see the merchant solution still driving a lot of growth here. And you can see here that they're throwing off quite a good amount of gross profit there, towards 50% gross margins. And same again, the heights the sales and marketing up, the research and development, because they've been making a lot of acquisitions. The acquisitions are because of the shipping or fulfillment part of the business that they've been investing in. So that's obviously driving up research and development a lot, and G&A quite a bit. And if it wasn't for them to keep reinvesting into the business, these losses wouldn't be down here. And obviously as well, there was a massive benefit from the Affirm investment they made last year, which they don't have this year. So that's why it looks a little bit worse than what it actually is. You look at the valuation, it's a lot cheaper than what it normally has. Same again, I'll say a bit like Square, it is a bit more of a premium business compared to the other companies that I mentioned here. But I think, Shopify in the next 5 years, people are still going to be using the platform from the sales point of view and the extra features they have and when they keep adding them in. So I can't see people moving away from it in the next few years. So I think it'll still do okay. The next one's Mercado Libre. So Mercado Libre is a company that operates in Latin America. They're an e-commerce business and also a fintech business, and they have become basically the Amazon of Latin America. Now, the recent earnings were very impressive. They came in with 44% year-over-year growth, and as many e-commerce companies are struggling, this company is not doing that. It's actually still performing very well. Now, the reason why Mercado Libre has come the Amazon of America is because they were very fast investing into their business, and they were opening up fulfillment centers quicker than what Amazon were, so they were doing very fast delivery. And also the big thing is there wasn't great fintech infrastructure into Latin America, so they made a fintech platform. And the fintech platform, obviously, when the people go to buy things online, they're making money from that, and then obviously they make things from the e-commerce part of the platform as well. Now, the great thing, once again, the fintech has better margins than e-commerce, and the great thing is fintech now, or their fintech platform, is now getting as big as the e-commerce platform, which is great because the bigger that gets, the more profit they will start generating, which is starting to happen right now. So they have really good incomes through a lot of Latin America countries. For example, you can see here the biggest ones, which is like Latin America, Argentina, and Mexico, and they have the other countries here, which is like Chile, for example. You can see here commerce was growing okay in all of these countries, but the big thing is when you look at the fintech growth, Brazil, that was nearly double, Argentina, it nearly doubled, Mexico, it nearly doubled, other countries nearly double once again, and you can see here there was a double up in the fintech revenue. So the more that this keeps going up, they'll generate more profit from this, and this is growing massive amounts. And obviously the e-commerce is still doing very well, because when you look at the e-commerce growth, it was still a kind of steady high 20%, which is still really good, but the fintech part of the platform is very interesting going forward. And the last one on this list, the smallest company on this list, a 334 million market cap, 10 times earnings, it's Lovesac. So Lovesac is an American furniture retailer. Now, obviously, it's a little bit of a risk buying a furniture stock into a recession. But the thing is when you do look at the recent earnings, they are still pulling out very good growth in what has been a very tough environment, which is very impressive. And when you think about the recession, is the recession going to last forever? No. So even though it could be a tough 12 months for Lovesac, I think in the longer term, when you look at what they've been throwing off, and even in a tough environment, what financials have been throwing off, it's been very impressive. Now, Lovesac themselves, they do these settees here. These sofas, they are easy to customize. You can just add little bits onto the sofa more. So you can see here they're unboxing another armchair here that they could stick on one side. If you wanted to make it a fall sofa, you can just add another sofa in. Very easy to change them all. If you wanted to change the color of the sofa, so if you have a black sofa and you want to change it into a blue sofa, you can just go by the covers and add the covers on, and they actually have a 40% repeat customer base because of that. That's correct. A sofa company has a 40% repeat customer base because of the ability to change these sofas up, add parts in, and also change the covers. And also they've added in this new stealth technology where they can add sound into your sofa, and the more features they add in, which it looks like they're going to do, obviously they're going to make more and more sales from these sofas. And at the moment it trades at 0.7 times revenues, 8 times EBITDA. On a normal times earnings, it's an 8 as well, and on a free cash flow, it's a 9, so a lot of single digits here, which is lovely, especially when you look at the growth that they've been throwing off recently, which is fantastic, and they should continue growing at a good 10 to 20% range going forward. And when you look at the balance sheet as well, immaculate, no debt on there, and the cash is a little low, but the reason why is they did invest into a lot of inventory in the last quarter, so there's not too much of a worry there, because obviously when you sell the inventory you'll get the cash back. And I've got a full video on Lovesac on the channel that's worth watching if you want a bit more detail on that one, but I know this video is dragging out a little bit now, so I'm going to rush through them last couple of picks, so hope that is okay. So those are the stocks that I've been buying recently. I hope you enjoyed it. It did go on a little bit, so I did rush the last ones at the end, but hey, I hope you're okay with that. So I hope you enjoyed the video. If you could, smash the like button. If you're new around here, subscribe, and I'll catch you in a bit.